In media res. When telling a story, start in the middle. That was the advice of the Roman poet Horace. And, well, when you're looking at the story of corporate debt, it's really good advice. See, it's really hard to tell where to start, and it's very difficult to know where it's all going. But it's got a big, fat middle. How fat? Well, as of today, June 18th, the total corporate debt issuance in 2020 is roughly equal to the total debt issued for all of 2019, about $1.1 trillion so far this year. It's a huge number, and we're expected to pass the all-time maximum that was reached of 1.37 trillion in 2017. See, this has been going on for quite a while. Total corporate debt is already over $10 trillion dollars, and by the end of this year, it's going to be something like 11 trillion dollars, which is 55% of total GDP. It's a big number. Why this explosion? Well, there are several reasons. The most important, of course, is that interest rates went way down. Some of what's going on today is refinancing that older debt at lower rates. But then again, the market really sets interest rates, right? So, how do you determine the interest rate on a bond? Well, it starts with the rating for the bond. Now, there are all kinds of categories that are issued by two different main companies. The one that's quoted the most is Standard and Poor's, not to be confused with Poor Standards, which would be different. And the other one is Moody's, which people don't really pay as much attention to. I mean, they're Moody. They've been through a lot of stuff they don't want to talk about. No, seriously, if you can't make fun of bond companies, what can you make fun of? Going by the Standard and Poor's ratings, anything less than a rating of BBB is considered non-investment grade or junk in the common terms. The definition of junk varies from one place to another, but that's about where we're at. The idea is that interest rates that are charged for a bond depend on the rating. So a bad rating means you get a higher interest rate. This is because some number of these bonds that are being put together in a pool for investment purposes are going to default. And therefore, the overall rate should come out about the same, balancing the risk. Now, a bond trader named Greg Obenchain recently looked at this very, very carefully and found, um, it doesn't work out that way. The market is actually pretty bad at pricing the appropriate interest rate for these high yield bonds. And there's a reason for that. Basically, what he found was that in 2019, last year, that 4% was about as good as you could do. And the lower you went in rating, yeah, the interest rates go up, but it doesn't really get you anywhere. If anything, it starts going down because the default rates go through the roof. Okay, so how much of this is all junk? I haven't been able to get a good figure on how much is being issued lately as junk, but there is a huge appetite for non investment grade bonds. Why? Well, interest rates are extremely low. They are so low that if you issue a standard investment grade bond with like what 1 or 2% yield, I mean, what's the vig? What's the benefit for the people who are issuing it? It's nothing. You need a little bit of interest in there to get everybody, well, interested. There has to be a little bit of a spread. So a lot of bond traders have been chasing yield. They actually like the lower rated bonds because they get a higher yield. But again, this is all set by the market. The first thing that happened in this great wave was that interest rates started going down. Woo, let's go refinance, especially all that stuff from like 2017 when all this really started. We can go refinance at a lower rate. But there was more than the market could handle. Interest rates went down for investment grade bonds to 3% or lower, and then they spiked up suddenly to 8%. That's when the Federal Reserve stepped in and said, we're buying a half trillion of corporate debt. And interest rates spiked right back down again because, hey, the Fed's going to absorb all of it. Yeah, this is where it gets tricky. I've been a little slow to report on this because the question was, where is this going to wind up? The answer is that BB, which is the Standard & Poor's rating, where you can kind of consider investment rating, it's a good cutoff point between the two. Uh, is at about 5.6% right now. It's a little bit high, actually, but they're issuing debt like crazy. Why? Well, a lot of companies are struggling during this crisis. They need money to keep going, they need liquidity. So they're taking out loans basically to endure the crisis. This is why the Federal Reserve had no problem buying corporate debt. I mean, it's an emergency, right? But here's the thing, corporate debt is supposedly for expansion of the business, for investment in it, not for like keeping it all going. I mean, we're basically taking out a second mortgage to pay the first at this point. That's not good. In fact, about 1/6 of all corporate bonds, again, this is a figure from before we went into this, but about 1/6 of all corporate bonds are what we call zombie debt, zombie corporations. This means that the company itself does not earn enough to pay the interest on the debt. They're just sort of waiting for a default. I mean, how big is that problem? Well, about 2.2 million jobs are controlled by that. So it's, 1.1% of the workforce works for a zombie company. Now, what does this mean to you? First of all, if all of this fails, it's going to be a cataclysm. There's going to have to be an incredible public bailout. The Federal Reserve has never bought corporate debt before. All right. This is obviously a temporary measure that they're doing just to give us all a nice soft landing and avoid liquidity problems. I think the theory is that by buying corporate debt now, that you avoid having to do a massive public bailout later. We're just going to give everybody enough scratch to kind of keep going. But there has to be an exit strategy at some point. The Fed can't keep holding corporate debt forever. Or can it? One would hope they have an exit strategy. We don't know what it is. But the Fed is providing the exit strategy for bondholders who are not exactly exiting. And corporations are only buying more corporate debt because they have problems. What else does this mean to you? Well, here's something to think about. Just consider some brand, some retail store, some company that you used to love, but just doesn't exist anymore, or it exists, but you really don't like it, whatever. Okay, just think about that. All right. Okay, I'm going to guess something that happened to the company that you are thinking of. Remember the last time you went into that store and all the fixtures were kind of dirty and outdated and the staff was kind of surly because they're underpaid and overworked. And you said to yourself, well, I'm never going back there again. It's been ruined. Okay? I'm going to tell you right now, go look up that company. And 5 years before that date that you made that decision, roughly 5, maybe 4 years before, there was a leveraged buyout involving non investment grade bonds. Okay? Retail sucks. Okay, the margins are tiny. Sometime I'm going to have to talk about the retail apocalypse and what's happening, but the margins are just always terrible. When you put a whole bunch of debt on top of a retail company, it eats the margins. Many of them become zombies. It's just the way it is. Now, we live in a time when interest rates are low. You'd think, wow, low margin businesses might have a benefit. No. See, there's way too much corporate debt being taken out. And it winds up killing companies slowly. The main point here is the effects from all of this debt won't be felt for years. In fact, we're probably now right at the beginning of this, before the coronavirus crisis, we were beginning to see the effects from the 2017 wave of corporate borrowing, which was the biggest year ever at $1.37 trillion. It's only been accelerating this year. And we're going to see the effects of it for years to come. Retail is dying. It's called the retail apocalypse for a reason. I mean, when was the last time you were able to go to a mall legally, right? They've been closed. So, what does all of this mean? What is the upside of it? First of all, a lot of the brands that you have learned to count on are going to start failing. It's just that simple. Uh, will there be a big public bailout of it? There already is kind of a public bailout of it. It's in the form of the Federal Reserve. It's only likely to get worse, and it takes years for this to work its way through the system. Some time ago, I talked about how we need to move to an equity based world, get away from the debt. We're going the opposite direction, if anything. And this debt provides basically an overhead. You have to pay the bondholders first before you pay what? Anybody else. And that overhead makes it very difficult for a lot of businesses to function. Now, at some point, everybody just borrows from everybody else, and you say to yourself, "What's it's just all circulating around. What does all of this money mean? What does the interest actually mean in the end if banks are borrowing from banks and traders are borrowing from traders?" Well, what it means is that everything has to remain dynamic. Everything has to keep going. All right, it has to keep on keeping on. When it all stops, that's when you have a problem. One person defaults and the whole chain starts defaulting. That's the issue with the virus so far. The lockdown put a stop on everything, and there's a good chance the rest of the chain will fall. And if there is a second wave or other issues or things like that, or a really bad retail Christmas, there will be, what exactly is going to happen? That's the issue at hand. What we do know at this point in the middle of the story is that corporate debt has been exploding, particularly non investment grade or junk corporate debt. Why? Well, they're chasing higher interest rates. The interest rates are low only because the Federal Reserve has intervened. Is the Fed going to have to continue to intervene? How do they get out of this? Wow, we don't know. There's a whole lot that we don't know. What we do know is that this much debt really doesn't produce anything good in the long run. It never does. Corporations, especially in sensitive areas like retail, need to operate with as low of an overhead as they possibly can. All of this debt is just increasing the overhead, making it much more difficult for that bottom line to contain a positive number. And it's going to be that way for a very long time. And if I'm right that deflation is going to win out over inflation, and the time value of money itself is kind of broken in coming years, then all of this debt, what? Only becomes more and more painful with each passing year. This is where the cure for the virus becomes worse than the disease itself. Right. At least in economic terms. It's something to keep an eye on. Not sure exactly where it's going to go, but this is going to take years to play out. What we know is that corporate debt is exploding, particularly high interest, high yield corporate debt. And it's mostly happening because the Federal Reserve is keeping those interest rates low. All right, we'll see everybody.